gold. The very word conjures images of immense wealth, power, and empires. For centuries, gold has captivated humanity's imagination. It's a tangible symbol of prosperity, passed down through countless generations. Emperors hoarded it. Alchemists tirelessly tried to create it. Its allure is truly timeless. Why has gold held such immense value? Unlike paper money, gold is finite and precious. You can't just print more of it. Unlike currency, this scarcity has made it a reliable store of value for millennia. From ancient Egypt to the Roman Empire, gold has played a pivotal role in shaping economies and civilizations. It's been the bedrock of trade, a symbol of power and a source of both conflict and prosperity. Today, gold still holds a unique place in the world. Even in our digital age, its allure endures. But is it still the investment powerhouse it once was? Let's delve deeper into its history and find out. The gold standard, a term that echoes through history, often romanticized as a time of economic stability and prosperity. But what exactly was it, and why does it hold such a significant place in our collective memory? The gold standard was a monetary system where a country's currency, or paper money, had a value directly linked to gold. Countries that adopted this system agreed to convert paper money into a fixed amount of gold. This meant that the value of the currency was directly tied to the value of gold, creating a stable and predictable economic environment. But how did this system come into being, and what were its implications for the global economy? The origins of the gold standard can be traced back to the early 19th century. It was during this time that countries began to adopt gold as the basis for their monetary systems. The idea was simple. By linking the value of currency to a tangible asset like gold, governments could ensure the stability and reliability of their money. This system required governments to hold large reserves of gold to back their currency. It also meant that the amount of money in circulation was limited by the amount of gold a country possessed. This created a sense of security and trust in the currency, as people knew that their money could be exchanged for a fixed amount of gold at any time. Think of it as gold-backed currency. The value of money was no longer based on the whims of governments or central banks, but was instead anchored to the value of gold. This provided a level of stability that was highly valued in an era of economic uncertainty. The United States adopted the gold standard in 1900, ushering in a period of economic growth and stability. This era is often referred to as the Golden Age of the gold standard. During this time, the US economy experienced significant growth, and the value of the dollar remained stable. However, the gold standard wasn't without its flaws. One of the main criticisms was that it limited a government's ability to respond to economic crises. Because the amount of money in circulation was tied to the amount of gold a country possessed, governments had little flexibility to increase the money supply during times of economic downturn. This rigidity in monetary policy meant that governments couldn't easily stimulate the economy by increasing the money supply or lowering interest rates. As a result, economic downturns could be more severe and prolonged under the gold standard. This rigidity eventually led to its demise. The limitations of the gold standard became particularly evident during the Great Depression of the 1930s. As economies around the world struggled, The inflexibility of the gold standard exacerbated the economic crisis. The Great Depression exposed the limitations of this system. Countries that were tied to the gold standard found it difficult to implement policies that could help alleviate the economic hardship. The inability to devalue their currencies or increase the money supply made it challenging to recover from the economic downturn. In 1971, President Nixon took the US dollar off the gold standard, marking the end of an era. This decision was driven by the need for greater flexibility in monetary policy and the desire to address the economic challenges of the time. This marked a significant shift in the global financial landscape, paving the way for the free-floating currency system we have today. Under this system, the value of currencies is determined by market forces rather than being tied to a specific asset like gold. This has allowed for greater flexibility in monetary policy and has helped to stabilize the global economy in times of crisis. Fast forward to today, and the price of gold is no longer tied to any specific currency. This detachment from a fixed standard has allowed gold to become a truly global commodity, traded and valued in markets all around the world. Unlike in the past, where gold was pegged to the value of a nation's currency, today it stands alone, influenced by a complex web of factors that can change in an instant. It fluctuates freely on global markets, influenced by a myriad of factors. These factors range from economic indicators to political events and even social trends. The price of gold can rise or fall based on changes in interest rates, shifts in government policies, or even the latest news headlines. It's a dynamic and ever-changing landscape that requires constant monitoring and analysis. Supply and demand play a crucial role. Of course, the amount of gold that is mined and brought to market can have a significant impact on its price. When new gold deposits are discovered, it can lead to an increase in supply, which might drive prices down. Conversely, if mining operations slow down or become more expensive, the reduced supply can push prices up. New discoveries of gold deposits can impact supply, while increasing global wealth can drive up demand. As more people around the world accumulate wealth, they often look to gold as a way to preserve and grow their assets. This growing demand can lead to higher prices, especially if the supply of gold does not keep pace. But there's more to it than that. Geopolitical uncertainty, inflation fears, and even currency fluctuations can all impact the price of gold. When there is political instability or conflict in key regions, investors often turn to gold as a safe haven. Similarly, when inflation rates rise, the value of paper money can decrease, making gold a more attractive option. Geopolitical uncertainty, inflation fears, and even currency fluctuations can all impact the price of gold. These factors create a sense of unpredictability in the market as investors try to navigate through uncertain times. The interplay between these elements can lead to sudden spikes or drops in gold prices, reflecting the broader economic and political climate. Remember, gold is often seen as a safe haven asset. This means that during times of economic turmoil or market volatility, investors flock to gold as a way to protect their wealth. The perception of gold as a stable and reliable store of value has been ingrained in the collective consciousness for centuries, and it continues to play a vital role in modern financial strategies. When investors get nervous about the stock market or the economy, they tend to flock to gold. This behavior is driven by the belief that gold will retain its value even when other investments are losing theirs. It's a form of financial insurance, a way to hedge against potential losses in other areas of their portfolio. This flight to safety can drive up the price of gold significantly, as we've seen during times of global crisis. Historical events such as wars, financial crashes, and pandemics have all led to surges in gold prices. These periods of uncertainty highlight the enduring appeal of gold as a refuge in troubled times. On the flip side, periods of economic prosperity and stability can sometimes dampen the demand for gold, leading to price dips. When the economy is strong and confidence is high, investors may feel more comfortable taking risks with other types of investments such as stocks or real estate. This shift in focus can result in lower demand for gold, causing prices to fall. So what's the current state of the gold market? Prices are volatile. The gold market is constantly reacting to new information and changing conditions. This volatility can be both an opportunity and a challenge for investors as they seek to navigate the ups and downs of the market. Factors like inflation, interest rates, and global events are constantly in flux, making it difficult to predict the future of gold prices. The interconnected nature of the global economy means that events in one part of the world can have ripple effects that impact gold prices everywhere. As a result, investors must stay informed and be prepared to adapt to changing circumstances. In conclusion, the price of gold is influenced by a complex interplay of factors, from supply and demand to geopolitical events and economic indicators. Understanding these dynamics is key to making informed investment decisions, whether you're a seasoned investor or just starting out. Keeping an eye on the gold market can provide valuable insights into the broader financial landscape. Despite its fluctuating price, gold retains a certain allure for investors. This allure is not just a modern phenomenon. It dates back thousands of years. From ancient civilizations to modern economies, gold has always been a symbol of wealth and power. Its unique properties and universal appeal make it a timeless asset. Why? Because it's a tangible asset with intrinsic value. Unlike digital currencies or even paper money, gold is something you can physically hold and see. This physicality gives it a sense of permanence and reliability that other forms of currency lack. When you hold a gold bar or a gold coin, you are holding a piece of history, a piece of the earth itself. Unlike stocks or bonds, gold isn't a piece of paper, representing ownership in a company or a loan to a government. Stocks can plummet in value and bonds can default, but gold remains. It doesn't rely on the performance of a company or the stability of a government. Its value is inherent, derived from its rarity and the effort required to extract it from the earth. You can hold gold in your hand. This tangibility is a significant part of its appeal. In times of economic uncertainty, the ability to physically possess your wealth can provide a sense of security that digital or paper assets cannot. There's a certain comfort in knowing that your wealth is not just a number on a screen, but something real and substantial. You can feel its weight. The heft of a gold bar or coin is a tangible reminder of its value. This physical sensation reinforces the idea that gold is a solid, reliable investment. It's not subject to the whims of the market or the decisions of a central bank. Its value is intrinsic, rooted in its physical properties and its historical significance. This tangibility provides a sense of security that paper assets simply can't match. In a world where so much of our wealth is digital and intangible, gold stands out as a real physical asset. It's something you can store in a safe or a vault, something that will be there no matter what happens in the financial markets. But the appeal of gold goes beyond its physical properties. Its historical and cultural significance adds to its allure. Gold has been used in art, jewelry, and religious artifacts for millennia. Its beauty and rarity have made it a symbol of wealth and power throughout history. This cultural significance adds an extra layer of value to gold, making it more than just a financial asset. Gold is often viewed as a hedge against inflation. When the value of paper money decreases, the value of gold tends to increase. This inverse relationship makes gold a valuable tool for preserving wealth in times of economic instability. As the cost of goods and services rises, gold often retains its purchasing power, providing a buffer against inflation. When the cost of goods and services rises, the purchasing power of paper money erodes. This erosion can lead to significant losses for those who hold their wealth in cash or cash equivalent assets. Gold, however, often moves in the opposite direction. As inflation rises, so does the value of gold, making it a reliable store of value in uncertain times. Gold, on the other hand, has historically held its value over time. This long-term stability is one of the reasons why gold is considered a safe haven asset. While other investments may offer higher returns, they also come with higher risks. Gold provides a balance, offering a way to preserve wealth without the same level of risk associated with stocks or bonds. This makes it an attractive option for investors seeking to preserve their wealth in the face of inflation. By including gold in their portfolios, investors can protect themselves against the eroding effects of inflation and economic instability. Gold acts as a financial anchor, providing stability and security in a volatile market. Furthermore, gold can act as a portfolio diversifier. Diversification is a key strategy in investment, helping to spread risk across different asset classes. By including gold in a diversified portfolio, investors can reduce their overall risk and increase their potential for long-term returns. Its price movements often don't correlate directly with stocks or bonds. This lack of correlation means that when other investments are performing poorly, gold may be performing well, and vice versa. This counter-cyclical behavior makes gold an excellent tool for balancing a portfolio and reducing overall investment risk.